Hi, welcome to a new episode of Accounting 330. Today we'll be finishing out Chapter 2. If you recall the previous video, we started out by talking about the characteristics of a good tax. The first characteristic we said was that a good tax should be sufficient, meaning that we should be able to raise enough revenue to meet the expenses of the taxing authority. Whether we were talking about a county level, a city level, a state level, a federal level tax, right? Any tax that is sufficient should be able to meet the expenses that are generated by that governmental body's spending. We discussed the federal income tax and we said that it was not sufficient, right? There has been a budget deficit for the past many years. We have not been able to raise enough tax revenue federally to fund our expenses. Our state income tax in the state of Kansas is sufficient, right? We're raising enough income taxes, we're raising enough sales taxes, use taxes, raising enough excise taxes at the state level to meet state expenditures. We talked about convenience as being another factor that is important in crafting a good tax, right? A tax that is convenient should be convenient to both sides of this equation. The governmental body should have an easy time administering it, and the taxpayers should have an easy time complying with the tax, right? Now, a great example of a convenient tax was the sales tax. We said that the sales tax is very easy for the government to administer because the government doesn't even think about it, right? The retailers of goods and services are the ones that are collecting the sales tax at the point of sale, and they are remitting it to the government. Similarly, a sales tax is very convenient for the taxpayer. When you go to a store, you don't even think about the tax. You just buy what you want to buy, you pay, what you're told, you move on with your life. You're not realizing that as part of that transaction, you've actually paid for a sales tax, right? A use tax is incredibly inconvenient, right? It might be convenient for the government because they don't really have to do much, but it is incredibly inconvenient to the potential payers of a use tax to the point where no one actually pays a use tax. So today we're going to move on and talk about the final two properties of a quote-unquote good tax, right? So number 3 is that a good tax should be efficient. And slightly different from the previous two concepts, efficiency is very steeped in economics. And therefore, whether or not you believe a tax is efficient is going to be very much contingent on which school of economic thought you subscribe to, and this is something that we're going to talk about in the next slide. The final property is that a good tax should be fair, and we're also going to talk about this, right? Equity, vertical, horizontal equity when we design a tax. Those are going to be concepts that we get into this class as well. So efficiency, right? A good tax should be efficient. And like I said, unlike sufficiency, unlike convenience, efficiency is going to very much depend on which school of economic thought you're coming into this argument from, right? There are two primary schools of economic thought. On the left here, we have a very handsome gentleman with a prominent nose in a beautiful powdered wig. That is Adam Smith. Adam Smith is the founder of capitalism. He's also the founder of classical economic thought. On the right, we have another very dashingly handsome gentleman with beautiful bushy eyebrows and a gorgeous mustache. That is John Keynes, right? And he's the founder of more modern economics, Keynesian economics. And as I said, our thoughts surrounding the efficiency of a tax are going to be really influenced by which school of economic thought we subscribe to. So with classical economic theory, the big takeaway, so if you take one thing away, is taxes should not distort behavior. If you know anything about capitalism, it's probably this concept of laissez-faire, right? It means the invisible hand. and it is the belief that markets are perfectly competitive, therefore they are efficient to the point that any sort of external regulation, any sort of external interference actually decreases market efficiencies, right? So that is the starting point for this classical economic argument that taxes should not distort behavior. We start off with the assumption is that free markets are perfectly competitive and efficient. Therefore, any alteration of resources results in an inefficiency. All right? Because the belief is that markets, as they are perfectly competitive, perfectly efficient, any alteration of the way that resources are allocated leads to inefficiencies. And taxes, by their nature, would fall under the umbrella of an alteration that influences resource allocation, right? So therefore, taxes would lead to inefficiencies. Now, whether or not you've bought into this idea that, you know, in a free market, everything is perfectly competitive and perfectly efficient, that's a totally different debate, right? But if you've bought into the idea, you're coming from that point of view, then this is the belief that you hold. Therefore, right, an efficient tax is a tax that doesn't interfere with or influence taxpayers' economic behavior. Because we believe that markets are efficient and they operate in a way where perfect competition leads to, you know, this immaculate allocation of resources, any external interference in the form of taxes should not distort taxpayer behavior if we are to say that those taxes are efficient. Now, this idea is rooted to a concept called deadweight loss, which hopefully I'll be able to illustrate with, you know, this example. So we have this fictional market where we're going to talk about cigarettes, right? And in our fictional market, we have a supply curve that looks like this, right? We're going to say supply, no tax. Now, this supply curve is representative of the amount of cigarettes that we as cigarette producers would be willing to produce at any given price, right? And this upward slope then makes sense because if a pack of cigarettes is $2, then we as cigarette producers would be willing to produce 17.5 billion packs of cigarettes. If a pack of cigarettes is $4, right, cigarettes are going at a higher price, then we want to make more money, so we'd be willing to produce 32.5 billion packs of cigarettes. If a pack of cigarettes is going at an even higher price, then we'd be willing to produce an even higher number of cigarettes to make more money. It would make no sense for us to only produce 17.5 billion packs of cigarettes if the going price is up here at, you know, $7 a pack. Similarly, it would not make sense for us as producers to produce, you know, 50 billion packs of cigarettes if the going price is only $2 a pack, right? We could better allocate resources. For most goods that we talk about on a market, this is a system that is going to hold true. Now, obviously, if we're talking about luxury goods, this is not going to be the case, right? But for most goods, this is going to be the case. If we're talking about Supreme duffel bags, or if we're talking about, you know, Air Jordans, or if we're talking about, you know, Gucci purses, right? This is not going to hold. In that case, those are luxury items, so even though the going price is very high and people would be willing to pay quite a bit to get those items, we want to create artificial scarcity in order to keep the price high, right? But this is going to be our supply curve, and the upward nature of the supply curve is representative of this association between higher costs and the desire to sell more of that good. Now the counter to the supply curve is going to be our demand curve, right? And the demand curve is downward sloping because it represents the price that, you know, we as consumers of a good, in this case cigarettes, would be willing to pay at any given price. So this downward slope is intuitive because, you know, at a higher price, we'd be willing to buy less cigarettes. At a lower price, we'd be willing to buy more cigarettes, right? Now, this point at which our supply curve and our demand curve intersects is called the point of equilibrium. It's our market equilibrium point. So in this market, we are essentially at a point where we're selling a pack of cigarettes for $3.75 a pack, and around 33 billion packs of cigarettes are sold. That is our market equilibrium point. Now, under such market conditions, this area right here that is above the equilibrium line and up to our demand line is called the area of consumer surplus. And this is the total benefit that accrues to consumers of cigarettes in this market. The reason it is the total benefit of you know, consumers in this market is because there are people that are on our demand curve at this point up here, or at this point up here, or this point up here, or this point up here, right? All of these points represent prices that are higher than the equilibrium price that you would be willing to pay for cigarettes, but because of the lower equilibrium price, you're not paying that high cost, right? So those regions are representative of a net benefit to consumers. On the other side of things, we have producers on the supply line that are at this point, or at this point, or at this point, or at this point, right? These producers would be willing to produce cigarettes at a much lower price, but due to the equilibrium price, they're actually making more money than they would have, you know, preferred to make. So this area right here is known as the area of producer surplus. And that is the total benefit that accrues to producers. So we have an area of consumer surplus and an area of producer surplus. Everything is at balance in this market with no taxes. Now, let's assume that there is a government authority, right, that is running some sort of budget deficit, and they need to raise revenues by implementing an excise tax on cigarettes, right? And an excise tax is a per unit tax on cigarettes. So it is going to shift our supply line as such, right? If it's a $1 excise tax at 12.5 billion packs, instead of a pack being, you know, let's say around 140, it is now going to be around 240 a pack, right? Oh, sorry, 240 a pack is up here. Instead of 20 billion packs being produced at 250, it is now going to be produced at 350, right? So we're essentially creating this new supply line that is our supply with tax, right? And the difference between these lines represents that $1 excise tax on a pack of cigarettes. Now, given our new supply line, we actually have a new market equilibrium, right? Under these conditions where we have a $1 excise tax, we're only able to sell 28 billion packs of cigarettes or 29 billion packs of cigarettes at $4.50 a pack, $4.55 a pack, whatever that may be. So the equilibrium price went up, right? The equilibrium price doesn't necessarily go up by $1 because the burden of this tax is split by both the consumer and the producer. However, the line shifts by $1, right? This shift in the line is $1. This change isn't necessarily $1. But we create a new equilibrium point for our market, right? Where a different quantity of cigarettes is being sold at a different going price. Now, what happens is we create this region, right? This rectangle here represents the amount of revenue that the government is able to generate through the use of this excise tax. So this is an area of government revenue. And actually what ends up happening is we now have a smaller area of consumer surplus, right? Previously it was the red diagonals, now it is the green diagonals. So this is consumer surplus, which decreases, so less benefits are accruing to the consumers, and similarly less benefits are accruing to the producers, right? So this is the new area of producer surplus, and it is also smaller than the previous area of producer surplus. Now, the idea of inefficiency comes from this area right here that is colored in yellow. Previously, this area was split between consumers and producers as an area of both consumer and producer surplus. Now we have three players in this market. We have the consumers, which are getting consumer surplus that is smaller. We have the producers getting producer surplus that is smaller. And we have the governmental body extracting revenue, right? But no one is able to benefit from this area in red, and that is the area of dead weight loss. So that is the lost benefit from both the consumers and the producers. It just vanishes due to the implementation of this $1 excise tax on cigarettes. And according to the classical school of economics, this area of dead weight loss is why any sort of change in the behavior of taxpayers, whether we're talking about suppliers that pay a tax or consumers that pay a tax, any sort of change in the behavior of these parties leads to inefficiencies. So this is where the inefficiencies come from in this market. Now, we have two additional examples, right? There's two slides where I'm going to talk about what would happen if we talk about a larger area, a larger tax on cigarettes, or a tax on a good that is not as elastic, so a more inelastic good, right? So assume we are dealing with cigarettes that, are more of an essential good, right? We are talking about a society where everyone is addicted. They absolutely need to get the nicotine rush, so cigarettes are considered to be inelastic. So assume the good is inelastic. And inelastic means it is more essential, meaning that the quantity doesn't change as much in response to price, right? Like if people absolutely need something, like let's say we're talking about, instead of cigarettes, let's say we're talking about insulin, right? People absolutely need insulin, so movements in the price will not affect the quantity purchased as much. So we would still have a supply line no tax. This time our demand line would have a much steeper slope, right? So this would be our demand line. Let's draw it out a bit straighter, right? So as you can see, this demand line is of a good that is not very inelastic. So it's a very elastic good, meaning that if price changes, quantity changes quite a bit. Here, this demand line is inelastic, meaning, you know, the amount that we purchase when this is $7 is really not that different than the amount that we purchase when this is $5, right? This difference is smaller on this line than it is on this line, right? The difference between $7, $7 would be somewhere up here, and $5 is somewhere down here. So this difference right here is much larger than the difference between 7 and 5 right there, because this good is suddenly inelastic. It is much more essential. We absolutely need it. So while quantity does move, it doesn't move as strictly. And similarly, right, we have a market equilibrium at this point, right? And we have, you know, consumer surplus up here, and we have producer surplus down here, right? And the government comes in and decides to implement a $1 per pen excise tax on, you know, insulin pens. So, you know, instead of having 12.5 billion pens at, you know, $1.40, we're now at 12.5 at $2.40 right here. And instead of having 20 billion pens at, you know, $2.25, we're now 20 billion pens at $3.25. So essentially we have this new supply line, right? Supply with tax. That creates this new equilibrium at this price. And once again, we have this rectangle. That is the amount of revenue that the government generates, right? We have this new area of producer surplus. We have this new area of consumer surplus. And we have this area of deadweight loss. So even with a good that is an absolute necessity, a tax does create a deadweight loss. It might be smaller, but certainly a deadweight loss still exists. To the Keynesian theory of economics, which was founded by, you know, John Keynes, we believe that taxes should have the explicit purpose of altering behavior in a way that is more desirable, right? If we want to curb pollution, we should put taxes in place that force companies and individuals to move away from polluting the environment. If we want to curb behaviors like smoking or consumption of sugary beverages, or, you know, like extremely high consumption of alcohol, then we should put taxes in place that are aimed to steer people away from those directions. So this is exactly the opposite of what is, you know, espoused by the classical theory of economics and what they believe efficient taxes should do. So if you subscribe to Keynesian economic theory, you believe that governments should deliberately use taxes to move an economy in the desired direction, right? And this is grounded in the assumption that markets are not perfectly efficient. Therefore, governments can use fiscal policy to correct inefficiencies, right? So in this case, a tax is efficient when taxpayers react to the tax by changing economic behavior. So this is the exact opposite of what a classical economics would argue, right? In the classical theory of economics, we said that any sort of interference in market operations is inefficient, so any sort of tax that causes interference in market operations is inefficient. With the Keynesian theory of economics, we believe that markets are inefficient to begin with. They're not perfectly efficient. So in order to move the markets to a more desirable location, a more desirable status, a more desirable direction, we would need to implement fiscal policy, one fiscal policy aspect being taxes, in order to influence behavior a certain way. Now, part of this has to do with this concept of negative externalities. Negative externalities are acts that are suffered by a third party as a result of an economic transaction. They are created when economic parties do not pay the full burden of the activity. So the reason that we believe, if we are subscribing to the Keynesian theory of economics, the reason that we believe markets are not perfectly efficient is because of negative externalities. Now, what is an example of a negative externality? Let's say, let's think about the activity of driving, right? Now, driving creates pollution, right? Automobiles create pollution, and this pollution affects third parties that aren't really a part of that economic transaction, right? The driving transaction occurs between the driver of the car and car manufacturers, gasoline producers, so on and so forth. But this pollution is a negative externality which affects third parties, right? We have a lot of people that live in areas with high amounts of smog that have respiratory problems, right? We have a lot of wildlife losing habitats because of, expansion of transportation systems. So pollution, road construction, accidents, congestion, right? These are all negative externalities that are created as a result of driving. And they affect people that are not party to that transaction directly. So, in order to, move individuals in a more desired direction of maybe taking public transportation or utilizing electric vehicles, we have different fiscal policy elements in place through taxation, right? There's credits on electric vehicles that are not available to, normal non-electric vehicles. There is an excise tax on gasoline. This is all an example of trying to use tax policy to shift behavior to a more desirable direction. So under a Keynesian school of economics, we would want behavioral changes as a result of our taxes. If there are no behavioral changes, then the tax essentially is not considered to be efficient. So here's a question to think about, right? What are some ways that the tax system could be used to address the negative externalities associated with driving? We talked about this, right? We have excise taxes on gasoline and diesel. We have credits for purchasing electric vehicles. So all of these are examples of like a Keynesian view of taxes. Taxes trying to shift behavior in a certain direction. Now, an outcome of this is what is known as tax preferences, right? Because governments try to highlight certain behaviors, try to influence certain behaviors, encourage certain behaviors, and try to dissuade people in taking part in certain types of behaviors, a tax system creates tax preferences. And essentially, tax preferences occur when tax policy is used as an incentive for certain behaviors, or when subsidies are given for preferred activities. So through tax preferences, we want to encourage certain behaviors, or we want to provide subsidies for certain activities. And what's interesting to note is actually tax preferences, they lose money for the taxing body, right? Tax preferences result in a loss of revenue for the Treasury. If the only objective of the tax system is revenue creation, then tax preferences would not exist. So some examples of tax preferences are, for instance, the favorable treatment of married individuals when they're paying taxes. As we get deeper into this idea of individual tax returns, you'll see that the deductions, the credits allowed for married individuals, individuals with children, are greater than the deductions, credits allowed for individuals that don't have children. Why? Because marriage, the formation of a family, is something that the government, the taxing body, wants to encourage, right? We want people to get married. We want people to have children. That's why we put tax preferences in place, which encourages getting married and having children. The issue is, the counter to that is, we are losing, as a government, we're losing tax revenue from married couples, from people with children, right? We want people to go to school, so there's certain credits and deductions associated with student loan payments. These are all tax preferences that create revenue losses for the taxing authority because we want to encourage certain types of behavior. So you can think about different types of tax preferences that you might have come across. Now, you can see here that, different tax preferences create significant losses of revenues, right? So this right here shows the loss of revenues from different types of tax preferences. Because we want employers to contribute for medical insurance premiums, employers, so corporations, can have a $235 billion tax preference, right? This is for fiscal year 2018. So this is an activity that we want to encourage, right? So we want to encourage certain types of investing activities, right? We want to encourage people investing in capital assets. So there's a $108.6 billion tax preference for fiscal year 2018. So this is essentially lost revenue for that, right? We want employers to contribute to their employees' retirement plans. So there is $69.4 billion of lost revenue that is a tax preference associated with employer, retirement plan contributions. We want people to own houses, right? The government encourages home ownership. So there is a mortgage interest deduction that leads to a $68.1 billion loss of revenue for the government. That is a tax preference, right? We want people to have children. There's a child credit that leads to a $54.3 billion loss of revenue for the government. So as you can see, all of these are different types of tax credits where the government is encouraging certain types of activities, and in response, individuals are changing their behaviors or corporations are changing their behaviors, and an outcome of that is a decreased revenue for the taxing authority. So the next concept relating to a tax is fairness, right? We talked about taxes being convenient, sufficient, efficient. Now we're going to talk about taxes being fair. So convenience was easy to administer, easy to comply with. Sufficient was raising enough revenues to counter those expenses that we have as a government. Efficiency, we said, was very tied to economics, which school of economic thought you subscribe to. If you're a classical economist, you think that an efficient tax is one that should not distort behavior. If you are a Keynesian economist, you believe that an efficient tax is one that distorts behavior in the desired direction, right? And in connection with that, we talked about negative externalities and tax preferences. So now we're going to talk about the final piece of this good tax puzzle, and that is fairness. Now most people would argue that a tax system should be fair. But what is fair depends on, who is arguing fairness. But generally, a tax is fair if taxpayers have the ability to pay the tax. The tax enhances horizontal equity and vertical equity. So everybody believes that a tax should be fair. No one believes that a tax should essentially punish one portion of the population while, another portion benefits. But what is fair depends on, what you believe is going to be fair. But if we're talking in more general terms, a fair tax is one where everybody has the ability to pay, and it enhances horizontal equity and vertical equity. And we're going to talk about all these here in the next slide. So, ability to pay is generally, when we're talking about ability to pay, what we mean is that each person's contribution to the government should not overburden the taxpayer. Right? When we talk about ability to pay, we mean that the taxpayer should not be overburdened. And there's two dimensions to this. One is magnitude. Does the tax, overburden the taxpayer? is he or she paying a fair share, right? And the second dimension of this is timing. Is the payment of the tax due at a time when the taxpayer has the resources to pay? So on the one hand, one consider with magnitude, right? The amount of the tax, is it too much for the taxpayers? But at the same time, we want everyone to pay their fair share. We don't want anyone to, shirk on tax paying. And the other aspect is the timing of this, right? Is the timing convenient? Is it fair? Are we asking people to pay taxes when they have the resources to pay the taxes, right? So from a timing aspect, a sales tax is extremely convenient. I mean, once again, and it's fair, right? Because you're paying when you're actually paying for the good. So you have the resources to pay for the good, and you pay for the tax as well. The income tax, it's debatable, right? You fill out your tax return, you get a big tax bill, but you might not necessarily have the resources at that point in time to pay for the taxes that you owe. But, the ability to pay concept has to do with the magnitude. So are you actually able to pay the amount, and are you actually able to pay due to the timing of this all? Now, we said that a fair tax should, take ability to pay into consideration. It should promote horizontal equity as well as vertical equity. So what is horizontal equity? Well, horizontal equity is, so let's say this, a tax that is horizontally equitable is a tax that is designed so that people with the same ability to pay owe the same amount. Now, let's look at this situation, right? When we talk about horizontal equity, we mean that people that are on the same horizontal level, right, we have the same ability to pay, we're going to be paying the same amount. So we have two scenarios here. We have a married couple with $100,000 of income and a married couple with $100,000 of income. So at face value, these two individuals, these two groups of people should have the same ability to pay. But do they in fact have the same ability to pay, right? One of them has 3 kids, pays an 8% state income tax, and has $60,000 of student loan debt. The other have no kids, no income tax, no student loan debt, right? So even though these are both married couples with $100,000 of income, do they in fact have the same ability to pay? Well, they don't, right? They don't have the same ability to pay because these people are incurring more expenses. So when we talk about same ability to pay, first of all, we need to work off of like the base income that we're dealing with. Like, because $100,000 doesn't mean the same thing to these two groups, right? So even though these couples have the same wage income, do they actually have the same ability to pay? No, they don't. So if we were to just design a tax that says, hey, if you make $100,000 of income, you have to pay this much, then that tax would not be promoting fairness. It would not be promoting fairness because there would be a lack of horizontal equity, right? That's why we need to roll in certain tax preferences into our tax in order to balance things out slightly, right? We need to say, hey, if you have kids, you get a credit. If you're paying a state income tax, that affects the amount of federal income tax you're going to pay. If you have student loan debt, you're making student loan payments, you have, interest associated with those payments are going to be subject to certain tax treatments, right? To create this more equitable base among similar horizontal levels of taxpayers, right? Now here's another situation. We have two couples, both married, with $100,000 of income. The couple on the left own a house, right? So there's a $2,000 mortgage payment. The couple on the right rent, so there's a $2,000 a month rental payment. Everything else is equal, right? So do these couples have the same ability to pay? Since everything else is equal, it might seem like, yes, they do have a similar ability to pay. But actually, home ownership creates a lot of additional burden, right? If you remember the very first lecture video, I showed you a picture, a snapshot of the property taxes that I was paying. So first of all, I'm paying property taxes that if I were to rent, I would not be paying those property taxes, right? So even though everything seems to be identical between these two sets of individuals, the fact that one is a homeowner, there are some additional hidden costs that might not be apparent at the surface level. So these two don't even have the same ability to pay. So we have tax preferences, right? That's where tax preferences giving to, a mortgage payment, or tax preferences associated with having kids or paying a state income tax or having student loan debt, that's where tax preferences can create this horizontal equity. So that's horizontal equity. People that have the same ability to pay the same amount of tax. And ability to pay is actually quite a nuanced concept, right? Which we can adjust with tax preferences. Now, what is vertical equity? Well, vertical equity leads to a tax system where taxpayers with greater means to pay have a higher tax burden than individuals with lesser means, right? And actually not many people would disagree with this concept. Debate primarily happens around, how much more should wealthier taxpayers pay, right? So with horizontal equity, we've created a system where people with similar abilities to pay are paying a similar amount of tax, right? We're adjusting ability to pay with tax preferences by finely tuning those dials. With vertical equity, we're talking about a system where people who have greater means pay more than people with lesser means. And actually, this idea isn't that controversial, right? No one is saying that a billionaire should pay less than someone who is, making ends meet, working multiple jobs, so on and so forth. Everyone, to a certain extent, agrees that people that make more should pay more. Where debate really happens is how much more should they pay, right? Because we have a federal income tax system where, as you earn more, you pay a higher percentage of your income into the tax system, right? I mean, if you remember the very first, once again, video, those tax rates range from 10% up to 37%, depending on where your adjusted gross income lies, right? The question is, how much more should the wealthy taxpayers pay, right? Is 37% enough, for instance? Should they pay 50%, right? Or is 10% low enough for the lowest earners? Should they pay 5%? So we have these two concepts of equity that are just trying to create a fair tax system, right? So let's look at this example. Taxpayer A has $60,000 of taxable income. Taxpayer B has $600,000 of taxable income. We have three different rate structures, and let's talk about the vertical equity of these rate structures, right? So for rate structure 1, this one right here, the first $10,000 of taxable income is taxed at 5%. The next $90,000, so from $10,000 to $100,000, is taxed at 10%, and anything above $100,000 is taxed at 20%. So for taxpayer A, right, we have the first $10,000 taxed at 5%. So this is going to be $500 of tax. And the next amount, which is going to be above $10,000. So since he's making $60,000, the $60,000 minus the $10,000 is going to be $50,000, is going to be taxed at 10%, right? So $5,500 is going to be the tax liability of taxpayer A under rate structure 1. All right, let me move this up here so we can do taxpayer B. Right, taxpayer B, once again, the first $10,000 is going to be taxed at 5%, so that's going to be $500. The next portion of taxpayer B's income is the portion from $10,000 to $100,000. So that $90,000 chunk is going to be taxed at 10%. So that is $9,000. And anything above $100,000, so we have $500,000, is going to be taxed at 20%. So that is $100,000. So overall, taxpayer B is going to owe $109,500 of tax. Now, is this a vertically equitable system? Yes, it is, right? The individual that earns less pays less overall. The individual that earns more pays more overall. Now, let's look at rate structure 2, right? With rate structure 2, taxpayer A is going to pay 20% on the first $10,000 for $2,000, and they're going to pay 10% on the next $50,000 for $5,000. So the overall tax burden is going to be $7,000 for taxpayer A. For taxpayer B, they're going to pay 20% on the $10,000, $2,000. They're going to pay 10% on the $90,000 for $9,000, and they're going to pay, 5% on the remaining $500,000 for $25,000. It's going to be $36,000. Right? So is this a vertically equitable system? Yes. The individual who pays less is the individual who is earning less, and the individual who is paying more is the individual who is earning more. Right? Now, how about this final rate structure, right? So A is going to pay 10% of all taxable income for $6,000, and B is going to pay 10% of $600,000 for $60,000. So at face value, right, all three of these tax systems seem to be vertically equitable. However, we're going to talk about a few concepts that's going to add a bit more nuance to this picture, right? I mean, tax rate structure 1 and tax rate structure 2 are both vertically equitable in that taxpayer B is paying more than taxpayer A. But once again, there's that debate around how much more should the higher earners pay, right? Is the higher earner, is taxpayer B getting off easy by only paying $36,000 in rate structure 2 compared to $109.5 thousand in rate structure 1? So debate over whether a progressive rate structure or a flat rate structure is more fair is a debate that would be very relevant in this example, right? So if you remember, with a progressive rate, there's a graduated rate that increases as income increases, right? So this is equitable because it places a greater burden on individuals with larger base, right? So if your tax base is larger, you have a greater burden of the amount of tax that you pay. Now there's another type of graduated rate structure, which is called a regressive rate, right? This is one where it's once again a graduated rate that increases as income decreases. So this is the structure that is evident in rate 2, a regressive income tax rate. And this, in fact, is inequitable. So on face value, it seems like the people that are earning more are paying more for all rate structures. But actually, rate 2 is placing a higher burden on lower earners. Therefore, rate 2 does not promote vertical equity. It is an inequitable tax rate structure, right? So we have a progressive rate structure that is equitable because it's placing more burden on those that are earning more. We have a regressive rate structure that is inequitable because even though those who earn more are paying more, so at face value it seems equitable, when you dig down into it, you realize that there's a greater burden placed on those that are earning less. So it's the opposite of actual vertical equity. And then we have a flat rate structure where the same rate is applied to all tax bases, right? So everyone is paying the same amount. And income taxes across the world, 37 nations have a flat rate, right? The rest have a progressive rate, and like one example of a big nation that has a flat rate is Russia. So Russia has a 13% flat income tax rate across all income tax brackets, right? Regardless of what you earn, you are paying 13% in Russia. Most nations have a progressive income tax rate. There is no nation with a regressive income tax rate because, as we said, it is vertically inequitable. No one wants to punish those who earn less for essentially earning less, right? And we have 10 states with a flat tax, right? So most states, as we talked about in the first chapter, have an income tax, and out of those, most have a graduated progressive income tax rate. So this is kind of a table that shows us this concept of vertical equity, right? Because it's showing you how much of the taxes come from the richest earners and how much of the income is earned by the richest earners, right? So Norway, as you can see, has ratios that are below 1. So Norway, Poland, I don't think anyone, yeah, and then there's Iceland, right? So these are nations where earners, for instance, you know, in Iceland we have the richest earners making 24% of the overall income of the economy, and they're paying 21% of the taxes. So, you know, 21% of the taxes that they pay divided by 24% of the income that they earn, that's a ratio of 0.9. Meaning that they are actually paying less of a percentage of their taxes when we look at the amount of money that they earned. On the other hand, you know, US has a fairly high ratio, 1.35. So the richest people in the US are only earning 33.5% of the overall income, and they're paying 45.1% of the overall tax. Now, these numbers, as we get further along in the chapters, you'll see that these are a bit deceiving. But at face value, it seems like, you know, most countries try to keep this as close to 1 as possible. You're not seeing any countries here that are overwhelmingly punishing one portion of the population or rewarding one portion of the population for earning, you know, high or low amounts of income. And you can see here actually that in the US, there was a point in time when the highest earners paid ridiculous amounts of taxes, right? If we go back to the 40s, during World War II or the lead up to World War II, you can see that the tax rate on the highest earners, you know, were close to 80%. So those rates have gradually come down, right? So we've had tax reforms with President Bush, who's dropped that down, and so those rates are now closer to each other, right? So everyone at every point in time agrees with this concept of vertical equity. Those who earn more should make more. But is this the fair amount? Is this the fair amount? Is this the fair amount? Like, what difference is the one that makes more sense, right? This is where generally we have debate. So when we're talking about vertical equity and horizontal equity, we want to think about a few additional concepts. We want to think about the concept of a marginal tax rate. We want to think about the concept of an effective tax rate, and we want to think about the concept of an average tax rate in order to really see if, in fact, there is vertical equity, right? So marginal tax rate is the tax rate that is applicable to the next dollar of taxable income. So we are talking about the tax rate that would be applicable to the next dollar of income that you earn. So if we look at this table, right, and we have this very rudimentary tax structure, what is your marginal rate when you increase $1 from 9,999, so you make 9,999 and you go to 10,000, right? That marginal tax rate on the $1 you earn is still 5% because you didn't change income tax brackets. You were in this bracket and you are still in this bracket. So the marginal tax rate on your additional dollar is 5%. What if we go from 10,000 to 10,001, right? You were earning $10,000 and you got a promotion where you're now earning $10,001, right? Well, now your marginal tax rate is 10% because you went from being in this bracket to now being in this bracket, right? I mean, the amount of increase in your actual tax will be negligible, right? Because when you go from 9,999 to 10,000, the entirety of your income is going to be taxed at 5%. So you are going to be paying $500 of tax, right? When you go from 10,000 to 10,001, your marginal tax rate changes because, you know, the first $10,000 of your income is still going to be taxed at 5%. So it's still 500. And the next, so your $1 is going to be taxed at 10%. So that is going to be, you know, 10 cents. So your actual tax is only going to be changing by 10 cents, but your marginal tax rate is going to change because your additional $1 is going to be taxed at that 10% tax rate. Now if you go from if you go from 99,000 to 100,000, right? 99,999 to 100,000, your marginal tax rate is still going to be 5% because 10%. Your additional dollar is not going to be charged at a different tax rate. But if you go from $100,000 to $101,000, then your marginal tax rate is going to be 15%, right? So your marginal tax rate is dependent on how much your additional dollar is going to be taxed at. Like $1 increase in your income and the tax rate that is going to be associated with that dollar increase. So if you go from 9,999 to 10K, your marginal tax rate is 5%. If you go from 10K to 10,001, your marginal tax rate is 10%. If you go from $99,999 to $100,000, your marginal tax rate is still 10%. And if you go from $100,000 to $101,000, your marginal tax rate, zoom out, your marginal tax rate is 15%. Right? So I hope marginal tax rate made sense. It's just the tax rate at which that additional dollar of income is going to be taxed. Right? Now, average tax rate and effective tax rate are slightly different. So average tax rate is total tax liability divided by taxable income. Effective tax rate is total tax liability divided by total economic income. And as you can see, the difference in between these two tax rates is what we use as the denominator. So we'll illustrate this with an example, but one is your total tax liability, so how much taxes you owe over what was your taxable income, and the other is how much taxes you owe over your total income. The key here is not all of your income will be subject to taxation, right? Whatever you get as a gross income is not what is subject to taxation. So in one instance, you're taking your gross income into consideration, and in the other instance, you are taking your taxable income into consideration. The larger the difference is between taxable income and total economic income, the larger the difference will be between your average tax rate and your effective tax rate. So your ATR and your ETR, right? And if we have a progressive rate, your marginal tax rate is going to be higher than your average tax rate. If we have a flat rate, your marginal tax rate is going to be equal to your average tax rate. Because at a flat rate, every additional dollar is just taxed at the same rate. All right? So let's get this example. Peter Parker has economic income of $60,000. So this is what his gross income is. And he has taxable income of $42,000. So he has $60,000 of total income. Only $42,000 of that income is subject to taxation. Based on the following tax table, what is Peter's tax liability? So how much tax does he owe? What is his average tax rate? What is his marginal tax rate? What is Peter's effective tax rate? So pause, work through it, and let's get back and solve it together. So Peter's taxable income, we said, was $42,000. So he has economic income of $60,000 and he has taxable income of $42,000. Now looking at the rate structure, right? Any amount up to $98.75 is going to be taxed at 10%. So we have $98.75 times 10% is $987.50, right? This is the current income tax bracket structure for a single taxpayer. And according to that, the first $98.75 is going to be taxed at 10%. So $987.50 is what he's going to pay initially. Then we say anything over $9,875 but below $40125 is going to be taxed at 12%. So the way we would do this is, since Peter's taxable income is above $42,000, he is still subject to this bracket. So we would take 40125, 40,125. We would subtract the lower boundary, which is 9,875. We would get, let's see what we get. So 40,125 minus 98.75, we get $30,250, which is taxed at 12%. So multiply that by 12%. We get 3,630, and then anything over 40,000 but not in excess of 85,000 is taxed at 22%. So we would take his total economic income of 42,000. We would subtract the limit, which is 4,125, right, which would give us 42,000 minus 40,125 is $1,875 times the rate there is 22%. We have $412.50, right? So Peter's total tax liability is $987.50 plus $3,630 plus $412.50, right? $412.50 plus 987.50 plus 3,630 is $5,030. So Peter owes $5,030 as an income tax liability. So this is his tax liability, right? So let's calculate his average tax rate. right? What was average tax rate? Average tax rate was total tax liability over taxable income. So his total tax liability is $5,030. His total taxable income was $42,000. That means his average tax rate is 11.98%, right? So that is Peter's average tax rate. So even though he was subject to a 10% rate, a 12% rate, and a 22% rate, because of his taxable income and his tax liability, his average tax rate is 11.98. Now, what is his effective tax rate? Well, his effective tax rate is his total tax liability over his actual economic income, right? So that's $60,000, meaning that we would divide 5030 by 60,000 to get 8.38%. So this is Peter's effective tax rate. Effectively, he's paying 8% of his $60,000 as a tax. And his marginal tax rate, what happens if his income goes up, his taxable income goes up from 42,000 to 42,001, right? Well, that income would still be taxed at 22%. So his marginal tax rate is going to be 22%. And when we're talking about concepts of vertical equity and horizontal equity, we need to think about average tax rates, right? If we go back to this example and calculate average tax rates here, you'll see that under rate system 1, this individual is, he has $5,500 of a tax liability and $60,000 of taxable income. So his average rate is going to be 5,500 divided by 60. It's going to be 9.1%. This average rate is going to be 109,500 over 600,000. So it's going to be 18%. Here, the average rate is going to be 7,000 over 60,000, which is 11.6%. Here, the average rate is 36,000 over 600,000, which is 6%. So this further illustrates how this system is not a vertically equitable tax system. That's it for this chapter. At this point, you should have enough to work through the second quiz, which will be available on the 2nd of September, and it'll go all the way to the 7th of September. I also have an activity that'll help you practice these concepts that I will post on Blackboard that you can work through, and I'll also provide a video with the solution for the activity. Thank you very much. I hope you have a nice day, week. Take care.